Good morning, Chris Vernon with Vernon Litigation Group. Today I want to talk to you about bonds. Most of us think of bonds as safe. It's a safer place to be than the stock market or some other type of investments. Oftentimes that can be true, but certainly not always. But I want to talk about a sort of a big picture issue with respect to your corporate bond portfolio and maybe some other products in your bond portfolio that feel and seem and appear and have been represented to you as very safe, but you may be overlooking one thing that is often not discussed by financial professionals out there, and that is the difference between duration and maturity. You could have a 30-year bond that might have a duration of just several years, and it may have been sold to you as though it has a short duration. That is important because the length of a bond, the longer your money sits out there as a loan, the more risky that loan is. That's just common sense when you think it through that way. And I think the securities industry has done a very bad job of confusing investors between the duration risk and the maturity risk. The duration can change dramatically with the economy. So in other words, you may think you have what I would call short-term bonds with less risk than long-term bonds, which could effectively turn into long-term bonds as the duration changes due to dramatic events or dislocations in the markets. So take a hard look at your bond portfolio and make sure that you're not taking more risk in terms of length of time of the bonds than you should be or than you think you are, because you're confusing, because of what your financial professional has told you, duration risk with maturity risk. Remember, whatever it is, let's make sure our money's working for us and not for somebody else. Have a great day.